Hi everyone, welcome to my channel. A bank reconciliation is the process of matching the cash balances in an entity's accounting records to the corresponding information on a bank statement. It is ideal to perform bank reconciliation regularly for all bank accounts to ensure that a company's cash records are correct. At a minimum, conduct a bank reconciliation shortly after the end of each month when the bank statements are received. Let's understand some of the items that may cause the accounting records and the bank statement to be different. On the left side, we have Bob's Farm Business accounting records of the cash account, and on the right, we have a January bank statement. Usually, transactions in the cash book are recorded according to the owner's best knowledge. Bank statement is received after the month ends, which is on the 1st of Feb. First, we have an opening balance of $0 at the beginning of the month. On 2nd January, Bob made an initial deposit of $1,000. Under the books, as Bob knew this transaction took place, he had also recorded these transactions in his books. This was also reflected in the bank statement. The next cash transaction in the bank statement is a direct deposit from a customer via TT of $150. As Bob was unaware of this transaction, he did not record in his books. According to the bank statement, there was also a bank service charge of $20 on 25th of Jan. Again, as Bob was unaware of this transaction, he did not record in his books. From Bob's point of view, the next cash transaction was on 29th of January, where he received a check from his customer and deposited it into the bank. And on the 30th of January, Bob issued $500 of check to pay his supplier, so in Bob's book, he had also recorded this transaction. Before Bob received the bank statement, this was the last cash transaction of the month. On the other hand, on the bank statement, there were no transactions on 29th and 30th like it's supposed to, according to the cash book. Lastly, on the bank statement, there was also a $5 interest income credited to Bob's account on 31st of January. As you can see, that there were quite a few things that were missing from either side. These items are called the reconciling items. As a result of these reconciling items, the ending balances in cash book and the bank statement were different. The first step to perform the bank reconciliation is to identify all the reconciling items. Let's first identify the reconciling items under the cash book. Here, the first item is the check received from customer, which was received by the company and recorded in the books. Deposit has already been sent to the bank, but not yet processed by the bank. This is known as the deposit in transit. This is common when checks are deposited close to the end of the month, outside of banks' operating hours, for instance on the weekends. The second item is the check payment to supplier. This is known as the unpresented check. These are checks that the company has issued and recorded in the books, but for some reason the amount has yet to be paid out from the bank account. One of the reasons could be that the payee has yet to present the check to his or her own bank. As a result, this reconciling item could be outstanding for a few months depending on when the check is presented by the payee. Most checks are valid for 6 months from the date of issuance, unless otherwise stated on the check. So, if your supplier did not present the check within the check's validity period, you will have to reissue a new check to the supplier. Next, let's identify the reconciling items in the bank statement. Here, we have direct deposit, bank service charge, and interest income. These are adjusting items that the company would not have known if they didn't receive the bank statements. These are also usually the ad hoc transactions. For instance, customers made a TT without informing you, so you will not have known. Other items will be recurring items such as interest income and bank charges. After you have identified all the reconciling items, the next step is to do up the bank reconciliation statement. Here, you just need to present the reconciling items which you have identified onto the bank recon statement. You should derive at the same adjusted book and bank balance. When the bank and book are in agreement, you are almost finished. On the bank side of the reconciliation, you do not need to do anything except contact the bank if you notice any bank errors. On the book side, you will need to do journal entries for each of the reconciling items. One of the advantages of doing a bank reconciliation is that it can prevent theft. As you are going to compare your book's transactions with the bank's financial transactions, you will be able to spot transactions that are recorded by the institutions but are not in your records. This will also reveal bank transactions that were initiated by unauthorized individuals who try to steal money from the company's account. By doing bank reconciliation, you will be able to detect accounting errors that commonly occurs in business, such as double payments, addition and subtraction errors, missed payments, and lost checks. For example, if you have mistakenly recorded an invoice as paid on your ledger, bank reconciliation can reveal that you have forgotten to write the check. Performing bank reconciliation also helps you to stay on top of every potential cash inflows and outflows. You will be able to monitor the amount that you can spend in your account. You are less likely to overdraw the account, which means withdrawing or attempting to withdraw more money than what your account has. I hope you find this video useful. If you like this video, remember to click on the like button. Thank you for watching. Bye!